One of the pet peeves that most consumers have with their banks is the lack of transparency and clarity by commercial banks on what they pay for loans and services rendered. A recent survey conducted by Ernst & Young on the banking industry indicated that lack of transparency on transaction costs are among the reasons why most customers shift from one bank to another. The banking sector in Kenya is now intent on changing this perception by implementing a standardized formula of calculating interest rates. From the 1st of July this year, banks will adopt an annual percentage rate in the calculation of the cost of repaying a loan. With the adoption of an annual percentage rate, commercial banks will calculate interest rates on the principal money borrowed on an annual basis. The computed interest rate will comprise three components, mainly the interest rate to be charged on the loan, the banking charges and fees, as well as related third-party costs such as legal fees, valuation, government taxes, and insurance costs. According to the Kenya Bankers Association, this shift will cut across the banking sector, thus enabling consumers to compare the cost of borrowing from one bank to another. Banks are presently required to only provide loan applicants with a breakdown of the total cost of credit, which include bank charges and third-party costs which are associated with the loan facility, and a loan repayment schedule in line with the central bank prudential guidelines. The move comes at a time when banks are under increasing pressure to reduce the gap between the interest rates charged on loans and what is paid on deposits. This as the Competition Authority of Kenya concludes a study into whether the prevailing interest rates charged on loans are competitive. Bella Genga, the Citizen Business Center.